Before you make your next real estate move, whether you're buying a home, investing in rental properties, or even considering selling, you need to hear what I am about to tell you, because I am seeing warning signs right now in the real estate market that I have not seen since 2007. And if you remember what happened in 2008, you know exactly why I am sounding the alarm. The real estate bubble is showing every classic sign that it is about to pop, and most people are completely oblivious to what is coming. They are sleepwalking into a financial disaster. I am not going to let that happen to you. Not if you watch this entire video and take the warnings I'm about to give you seriously. Let me tell you something most investors completely ignore. Bubbles do not announce themselves. They do not send you a notification on your phone saying, hey, the market is about to crash, you should probably sell now. No, bubbles feel amazing right up until the moment they pop. Everyone feels like a genius. Everyone thinks prices will keep going up forever. Everyone has a friend or a neighbor or a cousin who just made a fortune flipping houses or buying rental properties. And that collective euphoria, that feeling that real estate can only go up, that is precisely when you should be the most concerned. That is when the smart money starts heading for the exits. If you see what I see, you will act immediately. Because right now I'm looking at a combination of factors that historically have always preceded major real estate corrections. Interest rates that have risen faster than any time in 4 decades. Home prices that are still elevated despite collapsing affordability. Inventory that is starting to build in key markets. Commercial real estate that is in absolute free fall. And perhaps most importantly, a level of complacency among buyers and investors that reminds me exactly of 2006, when everyone thought housing prices could never go down. Must watch! Let me walk you through exactly what is happening and why I believe we are on the precipice of a significant real estate correction. First, let us talk about interest rates, because this is the single most important factor driving the housing market, and most people do not fully understand the mathematics of what has happened. In 2021 and early 2022, you could get a 30-year fixed mortgage for around 3%. Some people locked in rates below 3%. At a 3% interest rate, a $500,000 home with 20% down meant a monthly payment of around $1,687. That was affordable for a household earning the median income in many markets across America. Now look at where we are today. Mortgage rates have more than doubled. We are seeing 30-year fixed rates hovering between 7 and 8% depending on credit scores and market conditions. That same $500,000 home with 20% down now costs over $2,900 per month. That is a 72% increase in monthly payments for the exact same house. The house did not get bigger. The house did not get better. The house did not suddenly have more value. But the cost of owning that house increased by 72% almost overnight. The market will punish you if you ignore this reality. This is the fundamental problem with the current real estate market. Prices have not adjusted to reflect this massive increase in borrowing costs. In a rational market, when the cost of financing doubles, prices should come down significantly to maintain affordability. That is basic economics. That is supply and demand. But we have not seen that adjustment happen yet in most markets. Why? Because homeowners who locked in those low rates in 2020 and 2021 are refusing to sell. They are trapped in their homes by what economists call the golden handcuff effect. Why would you sell your home with a 3% mortgage and buy another home with a 7% mortgage? You would not. So existing homeowners are staying put, which is constraining inventory and artificially propping up prices. But here's the thing that most people are missing. This situation is not sustainable. Life happens. People get divorced. People have to relocate for jobs. People lose their jobs. People have medical emergencies. People die, and estates need to be settled. Eventually, all those locked-in homeowners will have to sell for various life reasons, and when that inventory starts hitting the market in larger volumes, prices will have to adjust to meet the current affordability reality, warns. We are already seeing the early signs of this in certain markets. Phoenix, Austin, Boise, many of the pandemic boomtowns that saw prices explode are now seeing prices decline 10, 15, even 20% from their peaks. Let me give you a real example that illustrates what I am talking about. I know an investor who bought a rental property in Austin, Texas in early 2022. He paid $650,000 for a single-family home that had sold for $380,000 just 2 years earlier. He thought he was being smart because Austin was growing, tech companies were relocating there, the population was booming. Everyone told him Austin real estate was a sure thing. Today, that same property would struggle to sell for $550,000. That is a $100,000 loss in less than 2 years. And because he put down only 10%, his entire down payment has been wiped out and he is now underwater on the mortgage. That is the reality of buying at bubble prices. The gains feel amazing on the way up, but the losses are devastating on the way down. Small investors must watch this carefully because it is the small investors, the mom and pop landlords, the first-time buyers stretching to afford a home who get hurt the most when bubbles pop. The big institutional investors have deep pockets. They can absorb losses. They can wait out downturns. They have teams of analysts and access to cheap capital. But regular people buying homes or investment properties with 30-year mortgages and limited cash reserves, they are the ones who end up in foreclosure when things go wrong. They are the ones who lose their life savings. They are the ones who spend decades trying to recover from a single bad real estate decision. Now let me talk about commercial real estate because this is where the bubble is already actively popping and most people are not paying attention. Alert! The commercial real estate market, particularly office buildings, is in a full-blown crisis right now. Office vacancy rates in major cities are at all-time highs. San Francisco has office vacancy approaching 35%. New York, Chicago, Los Angeles, they are all seeing vacancy rates that would have been unthinkable 5 years ago. Remote work has fundamentally changed how companies use office space. And those buildings that were valued at hundreds of millions of dollars based on rental income that no longer exists, those buildings are now worth a fraction of their previous values. Why should residential real estate investors care about commercial real estate? Because it is all connected. The banks that made loans on commercial real estate are seeing those loans go bad. When banks have losses in one area, they tighten lending in all areas. They raise their standards. They reduce their exposure to real estate. They become more conservative. And that credit tightening flows through to the residential market in the form of tighter mortgage requirements, higher rates, and less liquidity. Additionally, many regional banks have massive exposure to commercial real estate loans. If those banks start failing, it will create broader financial instability that affects all asset classes, including residential real estate. Let me tell you a story from 2008 that is seared into my memory. I watched investors who thought they were diversified because they owned multiple rental properties lose everything. They had 5, 6, 10 rental houses. They thought they were brilliant investors. But they had bought at bubble prices with high leverage, and when the market crashed, they could not make the payments. They could not refinance because their properties were underwater. They could not sell because there were no buyers. One by one, those properties went to foreclosure. 10 years of work, hundreds of thousands of dollars invested, all of it gone. These were not stupid people. They were successful professionals who got caught up in the mania and ignored the warning signs. Let me tell you something most investors ignore. The biggest risk in real estate investing is not the property itself. It is the leverage. It is the debt. A house can only go down in value so much. Even in the worst markets, houses do not go to zero. But when you buy a property with 90% leverage, a 10% decline wipes out your entire investment. A 20% decline puts you deeply underwater. And if you cannot make the payments because rents dropped or you lost your job or interest rates reset higher on a variable loan, you lose the property and all the money you put into it. Leverage is what turns real estate from a relatively stable asset class into a potentially devastating investment. Do not make the mistake of thinking you can time the bottom perfectly. I have been investing for decades. I have been through multiple real estate cycles. And I can tell you with absolute certainty that nobody, including me, can perfectly time market tops or bottoms. The goal is not to time it perfectly. The goal is to avoid the obvious danger zones. When prices are at all-time highs, affordability is at all-time lows, rates are at 2-decade highs, and everyone you know is talking about how great real estate investing is. That is an obvious danger zone. You do not need to predict the exact moment of the crash. You just need to recognize that the risk-reward ratio is heavily skewed against you. Now, let me give you some practical advice on what you should actually be doing in this environment. If you see what I see, you will act immediately on these strategies. First, if you are thinking about buying a home to live in, understand that your timeline matters enormously. If you are planning to stay in a home for 10 years or more, short-term price fluctuations matter less. You can ride out a downturn. You have time for the market to recover. But if you might need to move in 3 to 5 years, buying at current prices is extremely risky. You could easily find yourself underwater and unable to sell without bringing money to the closing table. In that situation, renting makes far more financial sense, regardless of what your real estate agent tells you. Second, if you currently own investment properties, it is time to stress test your portfolio. Run the numbers assuming rents drop 15 to 20%. Run the numbers assuming vacancy increases from 1 month per year to 3 months per year. Run the numbers assuming interest rates stay elevated for 5 years or more. Can you survive those scenarios? Do you have the cash reserves to weather a prolonged downturn? If not, you need to seriously consider reducing your exposure. Sell your weakest properties, pay down debt, build cash reserves. The time to prepare for a storm is before it hits, not after. Third, do not fall for the buy the dip mentality that works in the stock market but can destroy you in real estate. When stocks drop, you can buy small amounts and dollar cost average into positions. The transaction costs are minimal. The liquidity is immediate. Real estate does not work that way. When you buy a property, you are committing hundreds of thousands of dollars at once. Transaction costs are 5 to 10% between closing costs, inspections, and real estate commissions. If prices drop another 20% after you buy, you cannot just average down with another purchase. You are stuck with a property that is worth significantly less than you paid for it. Warns: catching a falling knife in real estate can set you back a decade financially. Fourth, pay attention to the leading indicators that will tell us when the market is actually bottoming. These include inventory levels, days on market, price reductions, and foreclosure rates. When inventory is high, days on market is extended to 60 or 90 days, price reductions are widespread, and foreclosures are rising. Those are signs of distress. When those indicators start to reverse, when inventory starts getting absorbed, when properties start selling faster, when price reductions become rare, that is when the bottom is forming. We are not there yet, not even close. In most markets, we are still in the early stages of the correction. The market will punish you if you ignore historical patterns. Every major real estate correction in American history has followed a similar pattern. First, prices get disconnected from fundamentals. Affordability deteriorates. People start using creative financing to afford overpriced properties. Then something triggers a change in sentiment. In 2008, it was the subprime mortgage crisis. In the early 1990s, it was the savings and loan crisis. This time, it is the rapid rise in interest rates combined with the commercial real estate collapse. Once sentiment shifts, prices start declining, first slowly, then accelerating. Sellers who held out start capitulating. Foreclosures increase. Prices overshoot to the downside as fear replaces greed. And then, only after the excess has been wrung out of the market, prices stabilize and begin a new sustainable upward trend. We are currently in the early to middle stages of this cycle. Sentiment is shifting. Prices are declining in many markets, but we have not yet seen the capitulation phase. We have not yet seen foreclosures spike. We have not yet seen the fear that marks the bottom of a real estate cycle. Those who bought at the peak are still holding on, hoping for a recovery. Many are still in denial about how much value they have lost. The smart money is waiting patiently with cash, ready to buy when true distress prices emerge. Let me address the people who will say, I am being too negative, who will say real estate always goes up, who will point to the last 20 years and say you cannot lose money in real estate. Must watch. I want you to understand something very important. Real estate does tend to appreciate over very long time horizons. Over 30, 40, 50 years, real estate has been a good investment. But that does not mean it goes up every year. That does not mean you cannot lose money. That does not mean timing does not matter. If you bought a house in 2006 in Phoenix or Las Vegas or Miami, it took you 10 to 12 years just to get back to break even. More than a decade of zero returns. And if you needed to sell during that period for any reason, you took a massive loss. Time horizon matters, entry price matters, leverage matters. I also want to address the argument that housing supply is constrained, and therefore prices cannot fall significantly. Yes, there is an argument that we have underbuilt housing for the past decade. Yes, there is structural demand from millennials forming households. These factors will provide some support to prices, but they will not prevent a correction. In 2008, we also had structural demand. The population was growing, people needed places to live, and prices still fell 30, 40, 50% in many markets. Because at the end of the day, prices are set at the margin by the most motivated buyers and sellers. If sellers become more motivated than buyers, prices fall. Period. Structural demand does not matter if buyers cannot afford to buy at current prices. And right now, affordability is at the worst level in 40 years. Small investors must watch this carefully because here is what I expect to happen over the next 2 to 3 years. Interest rates will remain elevated for longer than most people expect. The Federal Reserve has been clear that their priority is fighting inflation, and they are willing to accept economic pain to achieve that goal. Higher rates for longer means continued pressure on affordability and continued downward pressure on prices. Additionally, the commercial real estate crisis will intensify. More loans will come due. More buildings will be sold at distressed prices. More regional banks will face stress. This will create broader financial tightening that affects all real estate sectors. At some point, we will likely see a recession. The exact timing is uncertain, but the combination of high rates, tight credit, and consumer exhaustion makes a recession increasingly likely. When that recession hits, job losses will force more homeowners to sell. Foreclosures will increase, investor appetite will decrease, and prices will accelerate to the downside. This is not doom and gloom. This is just understanding how economic cycles work. Booms are followed by busts. Bubbles are followed by corrections. The key is to be positioned correctly when the inevitable happens. So what should you actually do right now? Alert! Here are my specific recommendations. If you are a homeowner with significant equity and a high-rate mortgage, do not panic sell. Your home is a place to live, not just an investment. If you can comfortably afford your payments and plan to stay for many years, short-term price fluctuations should not change your plans. But do build up your cash reserves. Having 6 to 12 months of expenses in liquid savings will protect you if anything goes wrong. If you are an investor with multiple properties, take a hard look at each one. Identify your weakest performers. Properties with negative cash flow, properties in markets with deteriorating fundamentals, properties with upcoming mortgage resets. Consider selling those properties now while buyers still exist, rather than waiting until you are forced to sell in a distressed market. Use the proceeds to pay down debt and build cash reserves. Being liquid and unleveraged in a downturn is incredibly valuable because you will be able to buy quality assets at discounted prices from distressed sellers. If you are sitting on cash waiting to buy, be patient. Do not let the fear of missing out push you into a bad decision. If you see what I see, you understand that better opportunities are coming. The sellers have not capitulated yet. Prices have not adjusted to reflect the new interest rate reality. When you start seeing widespread price cuts, extended days on market, increasing foreclosures, and desperate sellers, that is when you start looking seriously at purchases. And even then, negotiate hard. In a declining market, the asking price is just a starting point. Properties often sell for 10, 15, even 20% below asking when sellers are motivated. I want to close with a warning about human psychology because this is what causes most investors to lose money. We are wired to chase what has been working. When real estate has been going up for years, our brains tell us it will continue going up. We see our neighbors and friends making money and we want to join in. We are afraid of being left behind. This fear of missing out is incredibly powerful, and it causes people to buy at exactly the wrong time, at peak prices, right before corrections. Do not let your emotions override your analysis. The numbers right now do not support buying in most markets. Prices are too high, rates are too high, affordability is too stretched, the risk of loss is substantial. The greatest investors I have ever known share one common trait. They are willing to be patient. They are willing to sit in cash, earning modest returns while waiting for the right opportunity. They do not feel compelled to be fully invested at all times. They understand that sometimes the best investment is no investment at all. They wait for the market to come to them rather than chasing the market higher. And when the opportunity finally arrives, when prices have corrected and value has emerged, they act decisively with conviction. Let me tell you something most investors ignore. You do not get rich by buying at the top. You get rich by buying at the bottom, by being greedy when others are fearful and fearful when others are greedy. Right now, there is still too much greed in the real estate market. There are still too many people convinced that prices will keep rising. There is still too much complacency. When that changes, when fear takes over, when people are convinced that real estate will never recover, that is when generational buying opportunities emerge. And I want you to be ready for that moment with cash in hand and the knowledge to act. The real estate bubble is deflating. The question is not if prices will correct, but how much and how fast. Position yourself accordingly. Build cash, reduce leverage, stress test your properties, be prepared for the downturn. And most importantly, do not buy into the narrative that this time is different. It is not different. It is never different. The same cycle has repeated throughout history, and it is repeating again right now. Those who understand history and position accordingly will build wealth. Those who ignore the warnings and buy at bubble prices will suffer losses that take years to recover from. Thank you for watching this important warning. If you found value in this analysis, subscribe to the channel and turn on notifications so you do not miss future market updates. Share this video with anyone you know who is thinking about buying or selling real estate right now. They need to hear this message before making a potentially costly mistake. And remember, in investing and in life, the best offense is a good defense. Protect your capital first. The opportunities to grow it will come, but only if you have capital left to invest when those opportunities arrive. Stay vigilant, stay patient, stay liquid. I will see you in the next video.